Hello everyone. Today we'll take up with lecture 3 of redemption of preference shares, and 3 questions we'll be solving in today's lecture, question 5, 7 and 8. 5 and 7 I'll explain you on the screen. 8th question all of you will try completely on your own, and then you'll find the answers in front of you and you can verify whether you did correct or not. Look at question number 5. Now this goes without saying that before you start with the lecture, revise with the 4 conditions of section 55 of Companies Act 2013 and the 6 accounting journal entries which I made you read in the first lecture. Briefly revise them before you start watching this lecture. The following is the balance sheet of MIRC Electronics Limited as on 31st March 2017. Share capital 90,000 equity shares of rupees 10 each, 9 lakhs. 5,000 14% preference shares of 100 each. Quantity is already given. 5,000 14% preference shares of 100 each. 5 lakh rupees less final call of rupees 25 per share unpaid. Now total amount is 25,000 and 25 rupees is not paid, means on how many shares this final call is not received? Can we say 1,000 shares? These 1,000 shares are calls in arrears. Okay, these 1,000 shares are calls in arrears. Now first condition, only fully paid up preference shares can be redeemed, means these 1,000 preference shares cannot be redeemed if these preference shareholders don't pay 25 rupees to the company. Yes, if they pay 25 rupees to the company, then all 5,000 preference shares will be redeemed. But these 1,000 preference shares where there are calls in arrears, if they don't pay 25 rupees to the company even after the reminder, then the company has a right to forfeit these shares. But company will not redeem these 1,000 preference shares. Company will redeem only 5,000 minus 1,000, 4,000 preference shares. You all can see condition 1 and its explanation also I gave in lecture 1. Only fully paid preference shares can be redeemed. It had 2 dimensions. 1, if the shares are partly paid up. 2, if there are calls in arrears. This is the second dimension. If there are calls in arrears, we cannot redeem these 1,000 shares. Either they have to pay 25 rupees to the company to get the money back, or company has to forfeit and reissue the shares to redeem all 5,000 shares. Reserves and surplus. Profit and loss account can be used for both. Both means it can be used for redemption of preference shares as well as it can be used for writing of premium. Security premium account can be used only for writing of premium on redemption. And other than that, we have current liabilities, fixed assets, investments and current assets. Now, the board of directors decided to redeem only fully paid up. Only fully paid up means 5,000 minus 1,000, 4,000. That means these 1,000 preference shareholders have not paid 25 rupees to the company, and also the company has not forfeited these shares. So presently the directors have decided to redeem only fully paid up preference shares, which are how many in quantity? 5,000 minus 1,000, 4,000. 14% preference shares at a premium. So they are to be redeemed at a premium of 10%. On 31st March 2017, and to sell the investments at its market price of rupees 75,000. Investments are 1 lakh, sold at 75,000 means there is a loss of 25,000. So very first journal entry that will come is bank account debit 75,000, profit and loss account debit with the loss of 25,000, and to investments account 1 lakh. Company also decided to issue sufficient number. Underline this. Mark it important. If you recollect the past lecture, whatever 2 questions we solved, question number 13 and question number 2, quantity of equity shares issued, like in question 2 10,000 shares are issued, in question 13 also 40,000 shares are issued was already given. But here quantity of equity shares is not given. Sufficient number of equity shares are issued is mentioned. Now, what is this sufficient number? We will have to find. Company also decided to issue sufficient number of equity shares of rupees 10 each at a premium of rupees 1 per share required after utilizing the profit and loss account, leaving a balance of 50,000. We'll see in the workings how to cater this. Okay, basically, what is the difference? In the workings which we did in the last lecture, towards the face value, first we used proceeds of fresh issue of shares, then we used P&L account because quantity of equity shares issued was already known. I repeat, up till now the workings which we have been doing, how we utilized the two sources towards the face value. First we utilized proceeds of fresh issue of shares, then profits of the company. Why did we utilize proceeds first? Because quantity of shares issued was already given. But in this question, sufficient number means quantity of equity shares is not known. So first we will utilize profits of the company. Okay, whatever profits are available. And then whatever is the deficit required, for that only we will issue the equity shares. So it will go reverse. First we will use profit and loss account, then we will use proceeds of fresh issue of shares in the current particular question. And the logic and reason behind that is what? Sufficient number of equity shares is mentioned. How many equity shares are issued is not mentioned. So first we have to use all the profits that are available for the company, and sufficient number means just required amount to be financed by equity shares. For that only equity shares are to be issued. We'll see in detail when we make the workings. Also, there is a condition that in P&L account we have to leave a balance of 50,000. Premium on redemption is required to be set off against security premium account. So this also we have done in the last lecture. Premium on redemption can be written off from two sources, security premium as well as profit and loss account. But here it is clearly given that premium is to be set off against security premium only. So for premium, we will not use profit and loss account. You are required to show the journal entries. So first we will make the same workings what we have done in question number 2 and question number 13. Understand it properly. Today all the three questions what we are doing is similar one. So two questions I'll solve on the screen and one you have to try on your own. How do we used to make the workings? Very first we start with number of preference shares to be redeemed. Okay, number of preference shares to be redeemed. Now what did we discuss? 5,000 preference shares are there, but 1,000 are calls in arrears. So only fully paid up preference shares can be redeemed. Means 5,000 minus 1,000 where there are calls in arrears. We will redeem only 4,000 preference shares. Now, what two parts we used to make in the workings? Come on, tell me what two parts? First, premium, and second, face value. Now, first we write the face value. What is the face value? 100 rupees. Okay, face value is 100 rupees. And premium, how will we find? Here it is given that they are redeemed at a premium of 10%. Can you all see that? So 100's 10% premium will be 10 rupees. Now multiplied by 4,000 preference shares to be redeemed. So what is the total premium amount on redemption that we have to pay? 40,000. And 100 into 4,000 preference shares to be redeemed. What is the face value? 4 lakhs. Now, what are the sources and how to utilize this? How will we write off the premium? There are two sources for it. This comes under condition 4. Okay, premium as per condition 4 of section 55, premium can be provided or written off from two sources. First priority is security premium account and second priority is profit and loss account. So security premium account. Now what is the existing security premium account? See in the liabilities side, 20,000. So out of 40,000, 20,000 we will use from existing security premium account. And what about the remaining amount? Like if you refer to question number 2, what did we do in question number 2? Out of 80,000 we took 10,000 from security premium, the available amount, and then remaining 70,000 we took from P&L account. So in this question also, what will we do? Out of 40,000, 20,000 we will take from existing security premium, and remaining 20,000 we will take from profit and loss account. No, that is wrong. We don't have to take remaining 20,000 from P&L account. Reason number 1. Read this sentence. Reason number 1, read this sentence. Company decided to issue sufficient number of equity shares of 10 each at a premium of rupees 1 per share. Premium of 1 means, is the company going to get the premium from this issue of shares also or not? Maybe after getting that premium, you have sufficient premium to write off this 40,000. So we have to wait for that. I repeat, we have to first find out how many equity shares shall we be issuing, and maybe that premium is sufficient to make up with this deficit of 20,000. Also read this last sentence, everyone. Read this last sentence. Premium on redemption is required to be set off against security premium account only. In the last sentence, it is clearly given that use security premium only to write off this premium. We cannot use P&L account, means whatever number of equity shares we issue, the premium what we will get from that will be sufficient to write off this premium. Therefore, here I have mentioned the word existing. So now, what will be the new security premium? For that we have to wait. Keep it pending. New security premium accounts amount, keep it pending. Okay, why keep it pending? We'll have to wait and first find the number of equity shares to be issued. So let us go and proceed with face value part. Now, how to utilize this 4 lakh rupees? We have to here apply condition 2 and 3. Okay, in your notebooks what we have written, condition 2 and 3, they are to be applied. As per condition 2, there are two sources. One is profits of the company, second is proceeds of fresh issue of shares. In the last lecture, both the questions, first we use proceeds of fresh issue of shares, then we use profits of the company. Okay, both the last questions. First we use proceeds of fresh issue of shares, then we use profits of the company, but we cannot do that here. Why? Because in both of those questions, number of equity shares issued were given. So here first we will use profits of the company. Okay, first here we will be using profits of the company. Okay, first we'll find what amount is available in profit and loss account, which we have to transfer to capital redemption reserve so that the overall capital remains intact. Now, how will we find this? Understand it. Profit and loss account in balance sheet has a balance of 2,75,000. We cannot take entirely 2,75,000. Understand the reasons. This investments are sold at a loss of 25,000. So profit and loss account will decrease by 25,000. Loss on sale of investment we are going to debit to P&L account when we pass the journal entry. Means profit and loss account will decrease by 25,000 due to loss on sale of investment. Further, we have to keep a balance of 50,000 in P&L account. We have to maintain. We have to use P&L account leaving a balance of 50,000 rupees. So the balance to be kept in P&L account 50,000 also cannot be utilized. Out of 2,75,000, loss on sale of investment 25,000. So P&L account will decrease by 25,000. Further, we have to keep a balance of 50,000. So if you subtract this 75,000 rupees, what is the profit and loss account available for preference shares redemption? 2 lakh only. Okay, what is the P&L account balance available for redemption? 2 lakhs only. This 2 lakhs will be used from the profits and transferred to capital redemption reserve. Now, what is the balance or deficit amount still required? The balance or deficit amount still required is remaining 4 lakh minus 2 lakh, 2 lakh. For this 2 lakh, we have to issue equity shares. Means we have to manage this 2 lakhs by issuing equity shares. So for this 2 lakhs, equity shares are required to be issued. That's why it is given sufficient number of equity shares. So how will we find the number of equity shares to be issued? Okay, how will we find number of equity shares to be issued so that the share capital increases by 2 lakh rupees? 2 lakhs divided by the face value is 10 rupees. So if you issue 20,000 equity shares in the public, then 20,000 equity shares into 10, 2 lakhs of share capital will increase, 2 lakh will be transferred to CRR. So preference shares decreasing by 4 lakhs. From PNL we transfer 2 lakhs to capital redemption reserve, and by issuing the equity shares 20,000 shares into 10 rupees, 2 lakhs of equity share capital increases. Total preference share capital or share capital remains intact. So why did we use first P&L account and then equity shares, whereas in previous questions we used first equity shares and then P&L account? Did you all understand this difference? In those questions, number of equity shares issued were already given, and in this question, number of equity shares to be issued we have to find out. So whenever number of equity shares are not given, first use profits of the company out of the two sources, then you find out the proceeds to be raised from fresh issue of equity shares. Now, this 20,000 shares which you will issue, that will give you the new premium. You all can see here that premium is rupees 1. Can you all see here? Premium is rupees 1. So this 20,000 shares, what premium are you going to get? 20,000 into 1, 20,000 rupees. Will that be sufficient to write off this 40,000 or not? Yes. So how will you write off this 40,000? Entire 40,000 you will write off from security premium account. Existing security premium 20,000 and the new shares which are issued in public, from that also you'll get security premium of 20,000. So 40,000 can be written off from security premium account. So all of you keep this in mind. If number of equity shares issued are directly given in the question, then for the redemption of face value, first utilize proceeds of fresh issue, and for the balance amount take P&L account. Okay. If the number of equity shares to be issued are not given, then first utilize profits of the company, and for the balance amount you find out how many equity shares are to be issued. I repeat it once again. Very important point in exams. If number of equity shares issued are directly given, then first use proceeds of fresh issue of shares, and balance amount you take from the profits of the company. If number of equity shares issued are not given, then first you utilize profits of the company, and for the balance amount you find the number of equity shares to be issued. Again, in case of profits, don't use the entire profit given in balance sheet. Read the question, what are the terms and conditions, and accordingly you find out what profits are available for redemption. Pause the video and make the format of journal entries in the books of MIRC Electronics Limited. I hope you all are done with the formats. Let us pass with the entries. First entry will be for sale of assets. If in case this calls in arrears were called by the company and paid by the shareholders, then those entries, like we studied in unit 1, would have been passed in the very beginning. Okay, before you redeem the preference shares, we have received that money. But here it is clearly given that the directors decided to redeem only fully paid up preference shares. Means this 1,000 shareholders did not pay the money and they are not to be redeemed. So we straight away start with the 6 accounting entries what we have studied. First is sale of asset here. Investments of 1 lakh are sold at a loss of 25,000 for 75,000. So first entry will be bank is the receiver, debit the receiver, bank account debit with 75,000. 40,000. 25,000 is our loss. By the rule, debit all expenses and losses. Profit and loss account debit with 25,000. Investment goes out, credit what goes out to investments account. Investments of 1 lakh goes out. Being investments sold at loss. Okay, being investments sold at loss. Now, second entry to be passed is for issue of shares. We have obtained in this workings that 20,000 equity shares are issued, and it is given in the question that they are issued at premium of 1 rupees. So two entries will come for issue of equity shares at premium. First, bank is the receiver, debit the receiver, bank account debit. 20,000 shares are issued multiplied by 11 rupees because they are issued at premium of 1 rupee. What we are going to collect is 20,000 into 10 plus 1, 11. So 20,000 into 1, 2,20,000. And temporarily we will transfer the money to equity share application account, 2,20,000. Being application money received. And then the third entry will be equity share application account. You will reverse and debit to close it with full amount of 2,20,000 to equity share capital account with face value. So 20,000 shares into 10 rupees of face value, equity share capital account with 2 lakhs, and to security premium account with premium of 1 rupee. So 20,000 into 1, 20,000. Okay, these two entries are for issue of shares. Now all of you recollect, after issue of equity shares, what is the third entry to be passed? Third concept we studied for accounting, redemption of preference shares. Now redemption of preference shares will directly get from workings. Preference share capital account debit with 4 lakhs, and here it is given 14% preference share capital. Okay, so 14% preference share capital account debit with 4 lakhs, premium on redemption account debit with 40,000, and two preference shareholders, what we have to pay is 4,40,000. So 14% preference share capital as credit balance. To close it, we reverse and debit it with 4 lakhs. Premium on redemption is a capital loss, debit all expenses and losses. So premium on redemption account debit with 40,000, and amount is payable to preference shareholders. Credit the payables. So to preference shareholders account with 4,40,000. Being 4,000 preference shares to be redeemed at a premium of 10%. Again, 4,000 preference shares of rupees 100 each. Okay, of rupees 100 each to be redeemed at a premium of 10%. After redemption of preference shares, what is the fourth entry I made you write in the notebook? Writing off of security premium. Here, sorry, premium on redemption. Here, entire 40,000 we have to write off from security premium. Now, old or new doesn't make any difference. Both the premium go to same ledger account, that is security premium account. So don't write existing security premium account debit, new security premium account debit. Both are security premium only. Existing or old or new, both are one ledger account. In the ledger book, we maintain only one account, that is security premium. So directly we'll pass the entry for writing of the premium on redemption. Security premium account debit with 40,000 to premium on redemption account with 40,000. Okay, so this premium on redemption account we will reverse and credit to close it, and entire 40,000 is written off from security premium. Whether existing or new does not make any difference. Finally, it is written off from security premium only. So being premium on redemption written off. Now after writing off the premium, from the profits we have to transfer to capital redemption reserve. 2 lakh from the profits are to be transferred to capital redemption reserve so that the overall total share capital remains same. So profit and loss account debit 2 lakhs to capital redemption reserve account 2 lakhs, being profits transferred to capital redemption reserve. And lastly, for the payment of preference shareholders are the receiver, debit the receiver, preference shareholders account debit with what amount? What we have to pay to preference shareholders is 4,40,000. So preference shareholders account we will debit with 4,40,000. Okay. Preference shareholders are the receiver, debit the receiver, preference shareholders account debit 4,40,000. Bank is the giver, credit the giver to bank account 4,40,000. Being payment made to preference shareholders. Now final total is to be done. Okay, all the entries have been passed. So 1 lakh plus 440, 220, 440, so 540 plus 440, 980, 1020 plus 2 lakh 11, 1220 plus 440, 16 lakh 60,000. The final total, all of you verify that, 16 lakh 60,000. So this is how the question is to be solved. Even questions 7 and 8 are exactly similar, but still one more question I'll solve on the screen so that you get confidence with it. And 8 you all will try completely on your own. In fact, even 7th question, after discussing, if you feel that you can try on your own, you can pause the video and try it on your own. And then you can play the video to get the solution. You'll get more confidence with it if you are able to try the question on your own. Look at question number 7. The balance sheet of Aqua Limited as on 31/3/17 was as follows. 8 lakh equity shares of 10 each, 80 lakhs. 10% redeemable preference shares of 100 each, fully paid up. They are already fully paid up, so they can be redeemed. 24 lakhs. 24 lakhs divided by 100. How many preference shares are there? 24 lakhs divided by 100. 24,000 preference shares are there which are to be redeemed. Security premium account can be used for only writing off premium on redemption. Profit and loss account can be used for both. Both means it can be used for premium, it can be used for redemption of preference shares, as well as it can be used to write off premium. And other items of balance sheet are of no relevance. Following are the additional information available. Preference shares are redeemed on 31/3/17. Date is given in this question, so one time heading we can also give date in our solution. Now they are to be redeemed at a premium of 10%. To provide cash for redemption, investments are sold for 6 lakhs. You all can see in balance sheet investments are 7 lakh. They are sold for 6 lakhs, means at a loss of 1 lakh. So very first entry that will come would be bank account debit 6 lakhs, profit and loss account debit 1 lakh to investment account 7 lakhs. Minimum balance of 4,20,000 is required in P&L account. So this working what you do on the left side for P&L account. In this workings, minimum balance of P&L account to be maintained, like here it was 50,000. Here we have to keep minimum balance of 4,20,000. And minimum number of equity shares. But how many equity shares is not given. Okay, it is just like previous question, sufficient number of equity shares. Minimum number of equity shares of 10 each are to be issued again at 10% premium, means 1 rupee premium for the purpose of redemption. So just like previous question, since you are not given with number of equity shares, first we will use profits of the company, and for the balance amount we will find how many equity shares are to be issued. Exactly similar to previous question. Pass necessary journal entries to record the above transactions. So ideally I suggest that all of you pause the video and try the workings on your own. It is exactly similar to previous questions workings. In fact, easier than that because these calls in areas are also not there. So all the preference shares what are given in the question to 24,000 are to be redeemed. So pause the video and similar to previous workings, try it entirely on your own. However, I'll be doing it on the screen. But first you people try on your own and then play the video and verify you got it correct or not. Okay, I hope you all would have done with it. Now I am doing the workings and all of you verify whether you got it correct or not. So working note number 1, number of preference shares to be redeemed. Okay, number of preference shares to be redeemed is equal to 24,000. As we discussed, 24 lakhs divided by 100, 24,000 preference shares are to be redeemed. Now we will have two parts of the same. One will be premium and the second will be face value. First we will write the face value. Face value is 100 rupees each, and then we will write premium adjustment 1. They are to be redeemed at a premium of 10%. So 100's 10% premium is 10. Multiplied by 24,000 preference shares to be redeemed. So 10 into 24,000, 2,40,000 is the amount of premium to be written off, and 100 into 24,000, 24 lakhs. 24 lakhs of face value of preference shares is to be redeemed. Now, how will you write off this 2,40,000 as per condition 4 of section 55? There are two sources from which premium can be written off. First is security premium account. So what is the existing security premium account balance in the balance sheet? Look at it, everyone. What is the existing security premium account balance in the balance sheet? 1,20,000. So out of 2,40,000, 1,20,000 we will write off from existing security premium account. Now what is condition 4? Premium on redemption shall be provided out of first priority security premium account, second priority profits of the company. So will we take remaining 1,20,000 from the profits of the company? No, we won't take it. Why? Because last adjustment shares are issued at premium. We are going to get new premium, so we will wait for it. We will wait for new security premium, and maybe that premium is sufficient to write off this premium of 2,40,000. So right now we cannot use the profits of the company for the same. We first solve the face value part, then we come down to this new security premium account. Now, how will we utilize this 24 lakhs as per condition 2 and 3? Here we have to apply condition 2 and 3. Which source will we use first? Profits of the company or proceeds of fresh issue of shares? Profits of the company. Reason? Number of equity shares issued are not given. So first we have to utilize the profits of the company. Now for the profits of the company, we make the workings first. Profit and loss account already given in the balance sheet is 13,60,000. Okay, profit and loss account already given in the balance sheet is 13,60,000 minus what is the loss on sale of investments? Okay, what is the loss on sale of investments? All of you can see in adjustment 2 there is a loss of 1 lakh. 7 lakh of investments are sold for 6 lakhs. So there is a loss of 1 lakh that we will minus. And further, what is the balance to be kept in profit and loss account as per adjustment 3? We have to maintain minimum 4,20,000 in P&L account even after redemption. So 4,20,000 of balance is to be kept. Now 13,60,000 minus 1 lakh, 12,60,000 minus 4,20,000. So we can utilize only 8,40,000 for redemption. Okay, these are the profits available for redemption. What amount of profits are available for redemption? 8,40,000. So here the profits of the company which we will use and transfer to capital redemption reserve will be 8,40,000. Okay, they will be transferred to capital redemption reserve so that the total capital remains same. Now, what is the balance amount for which we have to raise the money by proceeds of fresh issue of equity shares? 24 lakhs minus 8,40,000. 15,60,000 we have to raise by issue of equity shares in the public. For this 15,60,000, what are the number of equity shares that we will have to issue? Number of equity shares to be issued will be equal to 15,60,000 divided by, what is the face value of equity shares? 10 rupees. So 15,60,000 divided by 10, 1,56,000 equity shares will be issued. Now what premium you will get on that 10%, 1 rupee? 1,56,000 into 1,56,000 of premium we will obtain. Now that premium we will use here. But we don't require 1,56,000. 240 minus 120, we require only 1,20,000. So remaining 1,20,000 we have 1,56,000 into 1,56,000 of premium will be received. Out of that, 1,20,000 will be used in writing of the balance premium on redemption. In short, 2,40,000 entirely can be written off from security premium account. Premium what we are going to receive will be sufficient to write off this balance amount. Okay, so this is how the workings are to be done. Again, I suggest you all can pause the video, make the format of journal entries in the books of Aqua Limited, and you all can try these journal entries entirely on your own first, and then you can play the video and verify whether you got it correct or not. All of you can pause the video and try these entries on your own. I hope you all would have done with the entries. Now see the entries what are passed. First entry is for sale of assets. So here 7 lakh of investments are sold for 6 lakhs. Bank is the receiver, debit the receiver, bank account debit 6 lakhs. Then 1 lakh is our loss, debit all expenses and losses. So profit and loss account debit with the loss of 1 lakh. Investment goes out, credit what goes out to investments account credit with 7 lakhs. Being investments sold at loss. Second entry is to be passed for issue of equity shares. We have seen here 1,56,000 equity shares are issued at a premium of 1 rupee. So for that 2 entries will come. First, bank is the receiver, debit the receiver, bank account debit with 1,56,000 into 11. Because of premium of 10%, 1 rupee, we are going to receive 11 rupees. So 1,56,000 into 11. 17,16,000. What we are going to receive is 17,16,000. Then equity, we temporarily transfer the money to equity share application account, entire 17,16,000 being application money received. Then third entry what we will pass is equity share application account. Just now what we credited, you will reverse and debit and close it with full amount 17,16,000. And then out of that to equity share capital account, what we will transfer is the amount towards the face value. So 1,56,000 into 10 rupees of face value, 15,60,000 we will transfer to equity share capital account, and to security premium account we will transfer 1,56,000 into 1 premium of 1 rupee, that is 1,56,000 being application money transferred to share capital and security premium account. So two entries for issue of shares are done. Now for redemption of preference shares, is it given in the question what percentage of preference shares are there? 10%. You all can see here 10% is mentioned. So what will be the next entry? 10% preference share capital account debit with 24 lakhs. Premium on redemption 22 lakh 40,000. Two preference shareholders 26 lakh 40,000. So all of it are on the fourth entry. 10% preference share capital account debit. Now preference share capital has credit balance. So to close it, we reverse and debit it with 24 lakhs. Premium on redemption is our capital loss. Debit all expenses and losses. So premium on redemption account debit with 2,40,000. Amount is payable to preference shareholders. Credit the payables. So to preference shareholders account 26,40,000. Being 24,000 preference shares of rupees 100 each, redeemed at premium of 10%. Now fifth entry, after redemption of preference shares, we'll write off the premium. So entire 2,40,000 of premium on redemption we have to write off from security premium account, we have seen. Okay, after the new issue of shares at premium, we have sufficient balance now. So security premium account debit with 2,40,000 to premium on redemption account with 2,40,000. So premium on redemption account we reverse and credit to close it, and we write it off from security premium. So security premium account debit, being premium on redemption written off. Now next entry, after writing off the premium, from the profits of the company 8,40,000 we have to transfer to capital redemption reserve so that the total share capital remains same. So profit and loss account debit with 8,40,000 to capital redemption reserve account 8,40,000, being profits transferred to capital redemption reserve. Okay, being profits transferred to capital redemption reserve. And last entry after that, payment is to be made to preference shareholders. So preference shareholders are the receiver, debit the receiver, preference shareholders account debit. What we have to pay to preference shareholders? 26,40,000. So preference shareholders are the receiver, debit the receiver, preference shareholders account debit 26,40,000, and bank is the giver, credit the giver to bank account 26,40,000, being payment made to preference shareholders. So all the entries have been passed. Now final total is to be done. So all of you see, do the totals in calculator. 7 lakhs plus 17,16,000 plus again 17,16,000 plus 26,40,000 plus 2,40,000 plus 8,40,000 plus again 26,40,000. That is 1,04,92,000. Okay, 1,04,92,000. 1,04,92,000 is the total. So this is how the questions have to be solved. I hope everyone is clear with them. See that next question now all of you are going to try entirely on your own. Okay, we'll read the next question, understand it thoroughly, but every one of you is going to try it entirely on your own with the workings. So first you'll do the workings, then the journal entries, and then I'll give you the solution in front of you and you all will verify whether you have solved it correct or not. So all of you look at question number 8, be attentive. The balance sheet of Jojo Limited as on 31st March 2017 was as follows. Equity shares, there are 3 lakhs. This percentage sign, make it 0. Okay, 3 lakh equity shares of rupees 10 each, fully paid up 30 lakhs. Preference share capital, that is 25,000, 6% redeemable preference shares of 100 each, 25 lakhs. Now this is similar to the first question we did in today's lecture. Final call of rupees 20 per share is unpaid, total 20,000. So 20,000 divided by 20. How many are calls in arrears? 1,000 shares are calls in arrears. Okay. Now, first condition. What is the first condition of redemption of preference shares? Only fully paid up preference shares can be redeemed. So out of 25,000, we cannot redeem 1,000 preference shares. We will redeem only 24,000 preference shares. Yes, if this 1,000 preference shares pay the calls in arrears, then we can redeem them. Then securities premium account, we have 1,50,000. So security premium account can be used only to write off premium on redemption. Profit and loss account can be used for both. It can be used for redemption of preference shares as well as writing off premium on redemption. Fixed assets, investments, cash, other items are given now. The board of directors decided to redeem the fully paid preference shares only at a premium of 10%. Fully paid preference shares means these fully paid 25,000 minus 1,000, 24,000 at a premium of 10%, and to sell the investments at its market price of 4 lakhs, 5 lakhs of investments sold for 4 lakhs means there is a loss of 1 lakh. You already know which entries are to be passed. Now I need not discuss it. I want every one of you to try it completely on your own. 2 questions I have already done on the screen exactly similar. They also decided to issue sufficient number of equity shares. Sufficient number means the number of equity shares are not given. So just like these 2 questions, first you will use profits of the company, and for the balance amount you'll find out second proceeds of fresh issue of equity shares to be made. Again, sufficient number of equity shares of 10 each at a premium of rupees 1 per share. So same way you'll do here for this premium, don't write off from P&L account because new shares are going to be issued at premium. So that premium will be used. You'll wait for that premium and that premium will be used. After utilizing profit and loss account, leaving a balance of 5 lakh rupees. So here in this P&L account workings, what balance are you going to keep in this question? 5 lakhs. Premium on redemption is required to be clearly given. Premium on redemption is required to be set off against security premium account. So in this workings, as such, you cannot use P&L account because it is clearly given in the question that use security premium account only to write off the premium. Pass necessary journal entries to record the above transaction. Pause the video and entire question you all try with the workings completely on your own. Then after that you play the video, entire solution will be there in front of you and you verify whether you did correct or not. All of you check your answers. I hope all of you would have done by now. Number of preference shares to be redeemed, 25,000 minus 1,000, so 24,000. Face value is 100 rupees and they are redeemed at a premium of 10%. So 100 into 24,000, 24 lakhs face value. 10 into 24,000, 2,40,000 is the premium. Now how will you write off this 2,40,000 of premium? From the existing security premium, 1,50,000. Okay, from the existing security premium, you'll write off 1,50,000. And this amount you'll keep pending. From the new security premium, you'll take remaining amount of 90,000. From the new security premium, you'll take remaining amount of 90,000, but you'll keep it pending. You'll do it after that. Now, 24 lakhs, how will you utilize as per condition 2 and 3? First, you'll make P&L accounts workings. As per balance sheet, there is P&L account balance of 15 lakhs. So first you write that. As per the paragraph, 5 lakhs of investment sold for 4 lakhs means there is a loss of 1 lakh. So here loss of 1 lakh, you'll subtract. And as per the paragraph, we have to leave a P&L account balance of 5 lakhs. So that also you'll minus. 15 lakhs minus 1 lakh minus 5 lakhs. 9 lakh of P&L account can be utilized. Now 24 lakhs minus 9 lakhs, 15 lakhs we have to manage through proceeds of fresh issue of equity shares. 15 lakhs divided by 10, how many equity shares will have to issue? 1,50,000. 1,50,000 into 1 rupee. Okay, 10% premium means, okay, 1 rupee premium means we'll receive 1,50,000 of premium. That will be sufficient to write off the balance amount of 90,000. Check your entries now. 5 lakhs of investment sold for 4 lakhs. So bank account debit with 4 lakhs. Profit and loss account debit with loss of 1 lakh. 2 investments account with total of 5 lakhs. Now 1,50,000 equity shares of 10 each are issued at 1 rupee premium. So bank account debit with 1,50,000 into 11, 16,50,000. To equity share application account 16,50,000. Equity share application account debit with 16,50,000 to close it. To equity share capital 1,50,000 into 10 face value 15 lakhs. To security premium account 1,50,000 into 1,50,000. Then for redemption of preference share capital debit with 24 lakhs. Premium on redemption 2,40,000 and to preference shareholders 26,40,000. See here. 6% preference share capital account debit 24 lakhs. Premium on redemption account debit 2,40,000. To preference shareholders account 26,40,000. Now how do we have to write off this 2,40,000? Entirely from security premium. So security premium account debit 2,40,000 to premium on redemption 2,40,000. Now from P&L account we have to transfer this 9 lakhs to capital redemption reserve. So profit and loss account debit 9 lakhs to capital redemption reserve 9 lakhs. And then we'll make the payment to preference shareholders. So preference shareholders account debit 26,40,000 to bank account 26,40,000. The total of journal must come to 1,02,20,000. So you'll get a lot of confidence, a lot of practice is there. Examination questions are also there to practice. You can find similar ones and try on your own if you have time and if you are done with the preparation of other subjects. More practice on the classwork questions we'll do in the next lecture. That'll be all for this lecture. Bye everyone. Take care. See you in the next lecture.